Good morning and welcome to the Opportunistic Trader for August 7th, a Tuesday. I want to first start out by going over yesterday's action for a brief moment and discuss positions that we have coming into this morning, and later on we will assess what we're going to do to increase the hedge or basically figure out what we're going to do around those positions. But yesterday was a fairly slow day for us. We really only came up with two trades. We were 1-1. We had a nice trade in crude oil, took about 60 cents out of that trade, and we came in short S&Ps as part of a spread from Friday with a call option to hedge the upside. And right now we're still in that position. We're hedged at this level. Obviously we need the market to trend back down, and that position will work, but we'll look at some puts for Wednesday expiration to maybe hedge off that exposure. Overall yesterday was light trading across the board. The markets closed firmer. The Dow was actually not up as much as the S&P and the NASDAQ, but I'm going to throw it to Vince to go over the overnight action and assess the landscape, and then we'll discuss positioning. Vince, I'm throwing it to you.
Thanks, Larry. Good morning. Well, I think the big piece of information, not too much happened last night, but what did happen was significant. Late in the day, and this was part of oil's run, the U.S. imposed new sanctions on Iran, and I think they were imposed at midnight, affecting, believe it or not, car parts, pistachio nuts, and rugs. The reality of it is that destroys the real, which is now approximately 100,000 to the dollar. And this is going to all be about oil, but just getting gold out of the way here. Countries like Iran and Turkey that are buying gold to hedge their own currency risk, that doesn't work in a nod to what Mark Fisher said yesterday, because you have to pay your debt in dollars. They're going to have to sell their gold to pay their debt in dollars anyway. So moving to oil, oil is now closing in on $70. And to the chagrin, I'm sure, of China, one of the industrial products that they must buy, they can stop buying copper, they can stop buying silver, they can't stop buying oil. And it's up 5% in yuan terms over the past few days. That's a big problem for them. Number two, the lack of oil coming out of Venezuela makes the Saudis happy. The Saudis, although we are truly a net exporting nation now, again, something Mark said yesterday, the Saudis get to sell more oil to us. So $70 oil, I think you said this, Larry, $70 oil ain't too bad if everybody's selling it except Iran. Moving to the equity markets, the markets are firmer last night. Actually, China's up, which would make sense because the yuan is a little bit stronger today as their capital controls kick in. Aside from the Turkish bath, the MSCI is about 2 to 3% higher, 2.5% higher. S&P futures are in the stratosphere. Rather than talk too much about the markets, I think the best way to discuss the equity markets and oil markets are based on our intimate feel from the trades done yesterday and how we're going to look at them moving towards today. But before I just throw it back to Larry, who's going to get into that, September crude is 69.70, I think, or 69.40. It trades in a tight range at high levels. Shanghai futures surged by their daily limit of 5%. So it's just not good for China right now. And President Trump, the tariff play is economic warfare. And again, another Mark Fisher statement yesterday. It's working so far. What we have to look at today, I guess, is what we're going to do with existing positions and what we see on the radar moving forward for today's opportunities. Like, for example, the S&P position, what would we do, and opportunities in oil again. And I see something brewing in metals as well. But that's pretty much it. Everything is up, which sounds easy to say, but it's probably going to be a good trading day, we hope. Larry, what do you think of the S&P up here, and how should we play it?
I just want to comment on a little bit of what you said. It's funny, I'm scouring my board right now, and other than debt instruments, it's my green board. So, the dollar's slightly weaker. S&Ps are up 5. NASDAQ's up 17. The indices were a little bit higher about an hour ago. Oil, which, is one of our focus trades because it trades so well every day, and it's a place where we could scalp, and our members of the Opportunistic Trader could get great trading opportunities because it's a market that fluctuates, is trading around $70. It closed weak yesterday. I was going to short it on the close, but thankfully we stayed away from that. We would look to short up in these areas, but we're going to have to watch the action. But I always find it funny. They're talking about Saudi Arabia, wanting to put out as much oil as they can, and this and that to try to bring down prices, but it's almost like CEOs of U.S. companies. They have a vested interest in higher prices. I remember maybe a year and a half ago, when oil was $30 or even lower. I mean, everybody was panicking to the downside. That there was a glut of oil, and we were looking at businesses to take in oil and store oil because there was so much oil out there that the deliverable oil was even lower. And
like getting tankers to store oil. That's how big it was.
Oh yeah, exactly. And now we're at $70, and there's basically no crude oil anywhere. So, to me, can we go higher? Sure, but we're in rarefied air for oil at this point, equities at this point, and it's funny. I actually looked at Jamie Dimon's comments on the debt market. He said that the 10-year note was going to go to 5%. My thought was it has to go to 3% before it goes to 5%. So I don't know what kind of call that is.
Well, he also hated Bitcoin the day before he liked it as an investment tool. So it is what it is.
No, I get that. I'm just saying though, I never understood people that were making market comments that were so far outside the box. Saying that the Dow will go to 50,000 before it goes to 30,000, is the same type of thing. So, I was reading on that, and I think, we're looking for opportunities. One thing that I've been good at through my career, and I'm sure you have as well, is being able to wait it out and being able to, when it's not there, not do anything. And for whatever reason, we're in dog days of summer, August 7th. So I'm not looking to press trades at this point. So that being said, we have our position, we're hedged. The market in here is about 1% on the S&P from the high. It's a question of whether it's going to make a top, lower than the high, which is probable, or it's going to take out the high. So we're going to, play off of that. Looking at oil, it looks strong for the moment. It's rallied a couple of bucks off its low when they slammed it $6. So again, critical area. They have inventories later today. It'll be interesting to see, what that looks like. As far as bonds, I'm not positioned, but I think it's a position that's going to go higher yield, lower prices for a while, almost in a way which you could probably touch on in gold. Gold's a little bit firm today, but overall it's been decimated. So
Right.
that's really what I'm looking at. But I don't see anything that looks like we're going to be too busy at this point. But as you know, that can change.
We have a couple questions coming in. I wanted to throw a couple trades in there and some comments on what you said before you get into your specifics. Um, I'm looking at today, because volatility is low, and this is not a retail type of trade, I'm looking at buying a 40 delta, selling a 20 delta hedged call spread on the S&P, playing the change in vol and hedging the upside. It's actually a bear play that mitigates risk to the upside volatility wise. On the metal side, again, to your point about the hardest thing to do is not trade. If you're trading metals, you're playing a lot of online poker, when there's nothing to do. But, the metals market is decimated. That is, it's demoralized. Pick a D word. The market is a little higher today on the back of yuan strength. A little pressure is off of them. But I stick to the report that I put out earlier. If you're using gold as your reference point, below 1229, you're selling rallies, and above 1229, 1231, you are buying strength. Anything in between is swing trading. If you want to swing trade, we go to oil. And oil, to your point, the Saudis may talk that they want it cheaper, but they do want it higher. What the Saudis are in favor of and are run properly is they're in favor of low volatility rallies. They don't like volatility. So that's something that we're having a reasonably orderly rally for oil. They're not unhappy about that. It's when it's high volatility, I think, that they get concerned. In oil, I would be looking to sell rallies with tight stops, but I have nothing on my radar, unfortunately, which is momentum based. We had some good trades yesterday. You may not have done many trades yesterday, but I think one of the members, one of the experts, Tracy, made a comment about team, and it's like we're recreating a virtual trading floor here. It's pretty good. Anyway, so those are the ideas that I have today.
Okay, I mean, I'm looking at volatility in here, on the S&P 500, which looks like it's trading about 1102. It's literally zero. It's almost like the last 4 months never happened, and when we get to these type of low vol environments, there's a lot of different spreading that you could do to take advantage of low volatility and get yourself a position that hedges you pretty good to the downside if you're long, or if you want to create a short to capitalize on a down move. It's pretty cheap to do. Put pricing in general is very, very low. We've seen this over the last bunch of years, and pretty much once a year, you can capitalize on that. So we'll keep an eye on that. But to me, looking at vol, I'm just surprised at where we were, in February, March, to where we are now, and how the marketplace always forgets so quickly about anything that has happened. So, that's one key takeaway that I see.
Yeah, I mean, a couple of years ago, we were worried. In fact, a year ago, the headlines were, it's the era of long volatility, right, Larry?
Yes.
and we have two new long VIX funds, and the short VIX funds are blowing out. Well, guess what? The new long vol funds are down for the year, and the short vol players are back. History may not repeat itself, but it certainly does hum the same tune.
It's interesting that you bring up that point, and to my thought, I don't, I mean, the short vol funds, I mean, they got blown out of the building. And, it's interesting. In February, I remember, basically getting a call from the clearing firm and telling us really not even to trade, that, their net capital was low and they had issues. It's funny that that problem was literally solved overnight. I mean, there were many futures clearing firms that were basically out of business that day.
Right.
So,
Right.
now,
The VIX play, one of the reasons volatility got so low and may be happening again, and I think the public should wrap its head around this. Pension managers were being advised. This is pension managers that are long stock. Traditionally, let's say you're Illinois Union Pension Fund manager. Traditionally, they're long stock, and their advisors may say, sell some calls to create dividends. Okay, I'm with that. They were actually being advised to sell puts. And here was the sales pitch. The sales pitch was, do you like Apple? Yes, we're long Apple. Then sell puts. Sell the puts in the X strike because you wouldn't mind buying more Apple at that price, would you? No, that's a great idea. And so you actually had long stock players selling puts and not understanding the fact that volatility would explode. And that's what happened to us. And God forbid if that is happening again.
Oh, yeah. I mean, it was actually pretty amazing. You had actual products be delisted overnight.
Right.
To see that was, but that's great opportunity. I mean, that's the stuff that at the Opportunistic Trader, our professionals have the ability to capitalize on and guide through those type of scenarios. When the market's kind of like this, it's pretty much easy for everybody in the sense that, you just keep buying Apple every day. And, if it goes to $1 trillion, now it's a trillion, 10 billion, and the 10 billion is more than so many companies out there. So since $1 billion, $1 trillion, it's adding billions like it's, nothing. So, it's interesting. It's interesting to look at, but, again, it's real quiet today. Oil will be a focus for us. It's trading up around 70. I'm sure they'll try to take it to 70 or above, see if it holds there. They have inventories later today. S&P is quiet. There's not really any numbers that are going to move that market. So, we'll be involved there, as well as, you'll keep us up on gold. And again, I want to, I'm not really playing it, but I do like bonds to the short side here.
Okay. Well, they do seem to get whippy in the 3% area. If you look at the yield instead of the price, it's quite amazing. It looks like Bitcoin almost. It would be a disaster if bonds sold off, because although a bond price selling off 1% is 1%, having yields go from 2.9 to 3.5 is an increase in your debt service if you're variable of like 25%. That's massive. So that would hurt the most people if you want to follow that play. I do want to, if you don't mind, to the volatility point, speaking to the experts, someone asked me on Twitter the other day, and I want to bring it here. The stochastic process of the market in the S&P, we have a put skew market generally, which means when the market rallies, volatility will come in. When the market drops, volatility should blow out. Rarely, and this is a good opportunity, and I have played this, when the S&P makes highs, usually new highs, and you see calls bought or volatility pop a little bit, that is actually generally bearish. It means fund players are running out of, it doesn't always mean this, it means fund players are running out of money to put in, and so they're buying calls. When that happens, it is actually time to buy that call and hedge it, because if we go higher, vol will blow out, and if we go lower, you will make a lot of money in gamma. Keep an eye open for that, because that's made money for me in the past. Like you said, vol's cheap. Who's left to sell it?
I don't know, the same computers or quants that have been selling it. They were off the program for a while, but
Maybe the Swiss National Bank, because why not? They own a lot of stock.
but that's funny. But it's interesting, like these volatility products like UVXY, which is a levered short volatility product, is
Right,
actually taking out the low of the year today.
right.
So
Well, and
which is
the
interesting.
last levered one, you remember the last levered one? I forget what it was called, but if they had to reprice it, it would have been negative because it was inverted. So they delisted it. That's the one you were alluding
Right. Well, they had
to.
a put warrant that no one knew. No one read the prospectus, so it wasn't really a security. It was like a put warrant, and basically, if it ever had an 80% down day, it would basically go into liquidation. So some players out there, won't name the names, pressed the stock down $80
Nice.
after the
So it was a
close.
knockout option.
Right. So they knocked everybody out. And ironically, if that product was alive today, it would be going the other way in a huge way. It would probably be, at that point, it went from 105 down to $8. I was looking to buy it, and I was speaking to someone at J.P. Morgan, and they were like, they read the prospectus, and they said, "Listen, you can't buy this if it trades $8.70. It's knocked out." I was like, "Oh my god!" And it was
Okay.
down like $88 without any news at all. So that was somehow manipulated in the marketplace, and but it's a lesson of what could happen. But it's interesting that they're back doing the same trades again.
Okay.
So
Yeah.
keep an
Well, you're
eye
going to
out.
let us know if you see something like that again.
Oh yeah, I mean,
Please, please, please. That this, with regards to oil, I got a quick question for you. It looks like it's a day trading product right now. I don't know if you want to trade light on your feet, if you want to trade through options, but overnight positions seem to be something. Look, between us, we're not an oil platform, but between us, I have 28 years of oil experience. Between the group, we have, active trading options. We have like over 100 years of oil experience between you and Tracy and Phil and myself. Uh, uh, this is going to have a lot of good intraday oil ideas. We all know what we want to do. Uh, uh, your macro ideas in oil are not that important on a day-to-day basis for us. What matters is intraday, what we see. So
yeah,
um,
absolutely. And our team is all over that, and we're giving out our trades and our thoughts in the marketplace to help people profit day over day. I look at myself as I trade oil probably every day, and I try to be close to flat on the overnight and take advantage of the day trading or the day movement in the product. It's trading at 69.70. It could easily trade down $1.50 from here or up $1. And to us, that's really, really good opportunity. One thing that it's interesting, before when we were offline, I wanted to talk about, which I really didn't get into, and I will get into in a webinar at some point, is sizing of positions, understanding market movements, knowing how, if you're trading, one lot, two lot, three lot, how to size your positions accordingly based on volatility. And, that's been very prevalent over the years in S&P,
right,
because S&P, I look, it's easy for me, it's not easy, but it's easy for me to look at pricing of the straddle. So I look at the straddle on the expiration and I say, okay, it's pricing in $9. And they're pretty good. The guys making the markets on this are pretty good. Obviously, they could be wrong at any point, but they're pretty good. So I'll size my position basis the fact that, the market's looking for a $9 move, and it's easy for
right.
me to hedge that as well. So if my lot size happens to be 100 E-minis and the move is looking smaller than what it traditionally is, I might size up to 150 as a start, and then I go from there to basically 1, 2, 3 star type of thing, for me to go to 450 lots, from
So you're
150
talking about,
lots if the
I
trade
think for the
is,
general
like
public,
a very highly convicted trade. But it's very important to understand movement and what we're looking for. And obviously sometimes it goes outside the box. We've seen that a bunch in crude oil. Like today we might think crude is, going to move 50, 70 cents, and that's what we're trading for, like we were trading for yesterday, 60 cents. That was a good move, but there are some days where crude will move $2 or $3. So you always have to be leery of that and use stops in the marketplace to hedge your risk.
I, I, I think you just made a point that
You there, Vince?
is relevant. Yeah, do you hear me?
I think we lost Vince, but
No, I'm here. I'm here.
anyway, just
I'm here. You guys hear me?
Yeah,
Okay.
I'm sorry, Vince.
Not only do we trade, and this is, I think, what, if I could just boil it down, not only do you and we trade volatility as an asset class, volatility is a key component to risk management. When you say a straddle's worth $8, in your mind, that's the average range I'm looking at. Things can get hairy outside of that, and you can adjust your volume, your stops, and your risk tolerances accordingly. Volatility, which is basically standard deviation, is an important risk management tool for all of us on the platform in managing intraday risk. And I think that's really misunderstood by a lot of the public. And I think that's something you should do a webinar on.
And I will, coming up soon. So that's sort of, what we see today. I'll be back to you guys pre-opening to give you actual trade ideas and thoughts going into the opening of the S&P at 9:30.
Right. 8:45, we got something coming on at 8:45, right?
it's going to come on closer to 9, correct?
Yeah. So it's Greg and FX. So he's probably going to come on at about 9, and look forward to hearing from him.
All right. See you online, Larry. Thank you.
All right.
Bye-bye.
Thank you.